given the earnings season that we expected back in early April and the one that we've gotten, a lot more guidance perhaps, are investors able to perhaps have a little bit more, at least with some businesses, certainty around what's coming?
No, absolutely. I think, earnings have been the biggest positive for this market now for the last several weeks. The March end season was quite healthy, definitely versus expectations. And then the April end season is turning out to be pretty healthy as well. There's really only been one major blow up in Target, and most other companies, and the Ross guidance is a little weak too, but most other companies, they're acknowledging the uncertainty, they're acknowledging a lot of the risk factors on the horizon, but they're managing through it. They're implementing a variety of different strategies to help mitigate some of the effects of tariffs, price hikes, cost cutting, et cetera. So corporate America has definitely been a big bright spot, and they're managing through this environment quite well.
Nicole, assuming this budget bill gets passed in something close to its current form, is it a positive or a negative in the medium term for markets, in the sense that there's been the talk about tax cuts, locking those in being great, but now we've also got the yield picture and concerns about the impact in the longer term on the deficit?
Yeah, I think this is one of these unique circumstances where you almost have to break policy apart from the strength we're seeing at the enterprise level, especially specific to our large cap companies. When we think about there being so much momentum in sectors like healthcare, industrials, financials, and then you put that in combination with the strength we see and the confirmation of continued CapEx spending, that bodes well for equity investors in a risk-on environment. On the other hand, the thing that we can walk away with was knowing the Tax Cuts and Jobs Act extension and that holding up for the consumer, versus reverting back to some of those previous tax rates. And we are fairly dependent on the consumer, especially in face of what we've gone through from a resetting of prices. So if tariffs have a way of acting more as a consumption-based tax, meaning hitting only those higher-end consumers we know are pretty flush with cash still, we actually think this could flatten itself out, but more to come, I think, as we see what passes on the Senate floor.
Adam, Morgan Stanley earlier this week turning bullish on most major U.S. assets, upgrading its stance on stocks and treasuries to overweight, raising some eyebrows in the process. Really a buy America call. Do you buy in?
I think for equities right now, the market's very extended, just because I think there's a lot of complacency around the effects of tariffs and the effects of fiscal policy. And there's just really very little wiggle room in valuations right now. So we closed at about 22 plus times on this year's consensus. If you go to 2026, you're a little bit under 20 times. So there's not a lot of valuation expansion potential, and you still have these big macro risks lurking on the horizon, most significant of which is the movement in yields and just the effects on inflation from tariffs. So, it'll be a very interesting summer. It looks like a lot of the pre-tariff inventory will be exhausted come June or July, and you could start to see some price hikes really start to show up in the data. And I think that will be a real test, for how the markets behave.